Hey everyone, welcome to today's Explainer. Today, we're unpacking the Reserve Bank of India's latest maneuvers to stabilize the rupee right in the middle of some serious global chaos. You know, when a currency is under this kind of intense pressure, a central bank really has to step up its defenses, and we're going to look at exactly how the RBI is doing just that. So the catalyst here is this breaking headline from August 5th, where RBI Governor Sanjay Malhotra explicitly announced their intent to aggressively monitor Forex volatility and just curb that speculative behavior. I mean, when the head of the central bank steps up to the podium with a statement like that, you know for sure there is some major movement happening right beneath the surface of the market. Here's our agenda for today. 1. The rupee under pressure. 2. Global pressures and oil. 3. The RBI defense strategy. And 4. Interest rates and reserves. Okay, Section 1. The rupee under pressure. A look at the currency's recent slip. The immediate action dominating the financial news cycle is right here. On August 5th, the Indian Rupee faced some really intense downward pressure, slipping back above the critical 95 per dollar mark. For those following the markets, you know this is a massive psychological and economic threshold. We literally haven't seen this breach since early July 8th to be exact. Now, what's actually super interesting about this is how the day started. The currency opened the trading day relatively strong, sitting at 94.92 rupees per dollar. But then, by 11:55 a.m. India Standard Time, it had rapidly slipped to 95.12. That is a swift intraday drop in value in just a matter of hours. And it's exactly the kind of sudden, jarring movement that immediately puts financial institutions on high alert and essentially demands a response. Moving right into Section 2, global pressures and oil, we're looking at the external catalysts driving the drop. Because let's be real, a drop like that doesn't just happen in a vacuum. To understand the RBI's quick reaction, we have to ask ourselves, what exactly are the global forces pulling the rupee down right now? We really need to look beyond domestic borders to get the full picture. Basically, the currency is caught in a total vice grip right now. On one side, you've got elevated crude oil prices acting as a heavy drag on the importing economy. And then, on the flip side, there are these renewed geopolitical tensions in West Asia. That instability is sparking a massive flight to safety, which is driving global investors away from emerging markets and straight into the perceived safety of the US dollar. This takes us to Section 3, the RBI defense strategy, curbing speculation and volatility. And this right here is the absolute core of the story. The central bank stepping in as the ultimate defender of economic stability. Governor Malhotra makes their stance crystal clear. He states that while they'll continue their policy of Forex being determined by market forces, they are simultaneously curbing excessive volatility, checking speculative behavior, and preventing disorderly movements. Essentially, they will not tolerate chaos. And they aren't just talking, they actually have a proven track record here. Remember earlier this year, the RBI levied some pretty heavy restrictions on the offshore non-deliverable forwards market, or the NDF market, specifically to curb speculation that had pushed the rupee to multiple record lows. Now, Step 2 was recently rolling back some of those initial measures to let the market breathe a bit, but make no mistake, they are keeping those strict daily regulatory guardrails firmly in place. To keep a really tight leash on all that speculation, they actively monitor a metric called the NOP-INR. That stands for the net open position on the Indian Rupee. It's basically just a measure of the total risk exposure that banks have to these ongoing currency fluctuations. The really crucial point is the limit itself, $100 million. The RBI strictly mandates that this net open position is capped at exactly $100 million at the end of every single day. It's a very precise regulatory ceiling designed specifically to stop institutions from taking massive, speculative bets that could destabilize the whole currency. Finally, let's dive into Section 4, interest rates and reserves, the foundation of economic stability. Let's zoom out and look at the broader macroeconomic tools the RBI is utilizing to reassure the markets. Their approach is incredibly calm and calculated. They've held interest rates absolutely steady at 5.25%. This is actually the fourth straight meeting without a rate hike. By maintaining this strictly neutral policy stance, they're signaling stability and making a point to show that foreign exchange reserves remain totally adequate. Speaking of those reserves, Governor Malhotra specifically reassured everyone that they have a 10-month import cover, which acts as a massive financial cushion against global shocks. For the broader economy, that means there is this huge safety net sitting ready to absorb the impact if the global economic situation suddenly deteriorates. It keeps everyday trade flowing smoothly. Now, that shows some exceptional preparation on their part, right? But it does leave us with a really critical question to close out today's explainer. With crude oil prices constantly fluctuating and those geopolitical tensions remaining persistently high, how long will these powerful global market forces continue to test the RBI's 10-month reserve cushion and its strategic defenses? It's a highly dynamic situation, and it's exactly why understanding the central bank's playbook is absolutely crucial right now. Thanks so much for joining me to break this all down.